So good morning, everybody. I'd like to welcome you to our ongoing In the Trenches series. We're continuing this morning with a topic we have touched on a few times previously, specifically the Main Street Lending Program that was subject to the recent documentation dump that occurred with the Federal Reserve Bank of Boston. I'm joined by three of my colleagues today in part one of this two-part series. Today, we're going to be focusing on the updates to the Main Street Lending Program, specifically looking at the impact it has had on lenders, specifically issues that may arise as a result of some of these changes, what you need to be aware of, planning for. And so I'm joined by three of my colleagues today. Those of you who have been participating in the In the Trenches series know Craig Nazaro, former in-house counsel, who now is part of our financial regulatory team. I'm also joined by two others who have spent time in-house with financial institutions, Brendan Ryan and John Willis, both of whom were with banks until recently and came, in one case, back into Nelson Mullins, in one case joined Nelson Mullins. And so we'll be presenting to you today about more of the practical aspects of the Main Street Lending Program, some of these concerns that have resulted. Obviously, our prior webinars have focused on the terms and the mechanisms under the Main Street Lending Program. Today, we're specifically focusing on some of the concerns that this is going to lead to for particular lenders. We're going to cover it in a four-part sequence. We'll first talk very briefly about the timeline and evolution of the program, just to kind of reset us into the structure of the Main Street Lending Program, how these changes have developed. We'll briefly cover borrower requirements and documentation, just to start framing those issues as we talk about lender concerns. Obviously, next Tuesday's webinar focused specifically on the borrower requirements, focused on what the borrowers are going to have to certify, some of the new requirements, ways of structuring around some of the issues that have arisen under the Main Street Lending Program. And then a lot of our focus today is going to be on the lender requirements documentation and the agreements with the Federal Reserve's special purpose vehicle who will be participating in these particular loans. And then finally, we'll talk a little bit about some of the open issues, pitfalls, unanswered questions that remain. A few issues on logistics. There is a question portal on today's webinar. If you have questions as we go through today, feel free to send those in. We'll try to get to those as we're talking. Love to hear what your feedback is. Logistically, we will be sending everybody who participated a copy of these slides, and a recording of it will be saved and available through the firm's portal, where all of our In the Trenches series webinars are recorded and then preserved so that you can go back, reference them, or forward them to others who may find these of interest. Let's talk briefly about how things developed. Materially, if you think about how Main Street Lending Program came about, there's been what many critics have said has been a significant delay. If you think about how this aligns with a lot of the shutdown orders, the shelter-in-place orders associated with COVID-19 pandemic. The first announcement of this was back in March, end of March 2020. Given the volume that's been generated here, probably not surprising to many of you who do participations, that it took the Fed some time to work through these programs. But it wasn't until May 27th, last week, when the Federal Reserve Bank of Boston finally issued a lot of the program agreements, the participation agreements, the servicing agreements, where we really began to get a lot of guidance on what's going to be expected of lenders participating in the Main Street Lending Program. According to Chair Powell, they expect that Main Street loans and the facilities will be available to begin purchasing participations perhaps as early as this week or more likely beginning of next week. And, a really interesting point is, as it stands, unless it's changed by regulation or Congress, the expiration date for these facilities is September 30th, 2020. So in kind of looking at that globally, you're going to have just over 3 months in order to make these Main Street loans before the deadline closes for submitting them to the SPV. So this is extremely timely. It's going to present a lot of challenges we'll talk about here shortly. But if you think about it from a logistical standpoint, these are new covenants, new warranties. There's a lot of kind of nuanced restrictions about collateral coverage, what have you. Unfortunately, there's not a lot of integration right now into existing commercial lending core systems in terms of the ability to obtain applications, underwrite, and then approve and generate documents. So a lot of this is going to be done on a manual or one-off basis. And so the lenders are really struggling, I think, based on feedback that we're seeing in American Banker from some of from clients. The ICBA released it to adapt to how they're going to do this at volume in this extremely tight timeline. So one of the things we'll talk about today is ways to potentially expedite that. Just to kind of set us back into perspective, we have 3 different facilities that are created under the Main Street lending programs. The new loan facility, the priority loan facility, which was actually released after the other 2 in a subsequent revision based largely on feedback from industry groups and various banking associations, and the Main Street expanded loan facility. Obviously, all of them 4-year terms, which is one of the criticisms that's been leveled. You can't go past that 4-year period. All principal and interest are deferred for 1 year on all of these to try to get people past the COVID-19 pandemic crisis. And as you may recall from some of our prior webinars, the loan size has been reduced on the priority and new loan facility to now down as low as $500,000. Unfortunately, that does leave inherently a little bit of a gap that we've got to deal with. If you think about the average size of the PPP loans, the Paycheck Protection Program loans that were being issued, round 1, right around $200,000 on average. Round 1 is getting down and close to about $100,000 on average. So there's potentially some gap there. Most of the banking organizations had advocated for a $50K minimum. Those of you who have been following the Main Street lending programs know that there is a EBITDA multiplier. They did some tweaking and now use adjusted EBITDA, but it's the mechanism for capping the amount of the loan that a particular borrower is able to receive. And then importantly, we have the payment terms. The new loan facility spreads it out evenly over the 3 years after the 1 year of interest and principal deferral. The other 2 facilities do a 15-50, 15-15-70 with that backloaded, in essence, balloon in the 4th year. That's been one of the major criticisms as we talk about what borrowers this may be most appropriate for. You can see there are those 3 different models as you're thinking about how this is going to work, where one is, in essence, a 3-year amortization. A lot of borrowers that were looking at the new loan facility are really worried about the ability to cash flow in that short of a period of time, where you're going to have only 3 years in order to repay what potentially is a very large loan. And then on the other 2, obviously concerns for lenders about borrowers being able to take out that 70% payment obligation in year 4. Let's talk a little bit about that. Obviously, the Federal Reserve's SPV and the banks are going to be splitting it because it's a participation. 595 was what originally came out. The priority loans shifted it so that there's actually a 15% retained interest by the lender with the priority loan facility. Obviously, prepayments allowed, similar to what we've seen traditionally in regulated consumer loans. Obviously, somewhat different than what you typically see in a commercial context, but yes. And then there are the restrictions on the size. Again, the idea is this is under 15,000 employees or 2019 revenues $5 billion or less, including affiliates. And so as we think about who this potentially works for, it could pick up people who otherwise would have been eligible for PPP, Paycheck Protection Program loans, who were under that, under the 500 employee threshold. Now it's 15,000 employees or less. So there is some potential you could double dip if you qualified for both, or potentially qualified for the PPP because you're in hospitality or one of the other beneficial industries. When we think a little bit about what the lenders are going to be paid, just to kind of keep all of this in perspective, there's an origination fee paid by the borrower that's passed on to the borrower of 100 basis points for both the priority loan and the new loan at 75 basis points for the expanded loan facility. There's then a transaction fee of that same amount that is paid over from the lender to the SPV that's calculated 100 basis points or 75 basis points. And then, one of the nice things is there is a servicing fee that is paid by the Federal Reserve's SPV to the lender. That's 25 basis points per annum on the amount that the SPV is currently holding. So that's to hopefully defray some of the lender costs associated with it. And then one of the things we'll talk about later on is some of these issues with subordination. One of the things that a lot of our lenders are calling and asking questions about, and that's so key to as we think about who could use these Main Street loan products, is you cannot subordinate these. To the extent it is secured, it must either take priority over existing secured lending obligations, except for mortgage or real estate debt, or it's got to come in pro rata with those existing facilities or those existing loans. And so obviously, if it's a single lender with a single outstanding loan obligation, that's fairly straightforward. One of the biggest concerns we've had is folks calling in and saying, we have a borrower who may have credit facilities with 5, 6, 7 different lenders, or you have various groups who are making individual loans to those particular borrowers, and you're going to have to deal with all of those as you underwrite and start looking at their eligibility for Main Street lending programs because of that restriction on subordination. One of the things that was changed in the most recent guidance and term sheets is early, and we'll talk about this in a moment, the index was going to be SOFR, the Federal Reserve's quote custom replacement for LIBOR that is scheduled to be discontinued in 2021 in the wake of some of the price fixing scandals. Because of pushback from a lot of the lenders and banking organizations, the Fed went back to LIBOR plus 3% as the index. We'll talk about the challenges associated with it, but very similar to what you're dealing with already in your commercial lending programs or any other consumer loan programs that are indexed to LIBOR. You can look, you see it's a 4-year term. LIBOR is scheduled to phase out in 2021. You need to start thinking about alternative indices that you're going to be using and how that's going to play in, particularly given that the spread of LIBOR plus 3% is fairly market on this. One of the big things, and as I say, part 2 of this presentation on Tuesday, the borrower side of this, we'll get into these in a lot of detail, but it's important to remember some of these restrictions on borrowers that are particularly important for lenders who are considering these loans, mainly because you're going to have to enforce these restrictions or at least review borrowers for compliance with these restrictions. Or alternatively, some of these are actually in the certifications that the borrower is going to be providing. The most important one that a lot of lenders are concerned about is borrowers cannot use these proceeds to repay other unmatured loan balances. So you can't effectively use this as a way to refi out of existing debt. There's a few caveats to that in some of the programs we'll talk about in more detail, but generally, if it is an unmatured loan balance, you're not allowed to come in and start refining it and in essence shifting those risks over to the Federal Reserve's SPV. And a lot of that is, if you think about it, there was $75 billion allocated for the Main Street loan program. The intent of the Federal Reserve is to put out $600 billion in available capacity for the participations, meaning they've levered that $75 billion up to $600 billion. And if you just think about what that means, is they're expecting losses to not be excessive. They're not expecting more than $75 billion in losses on a $600 billion portfolio. And so given that, one of the things that you'll see is this program, unlike PPP, was not made to help borrowers who are having business problems. It's really not designed for businesses that are likely to fail in the near term. At the same time, it's really not designed to be available for businesses that are doing very well right now and healthy. It's generally somewhere near market rates for borrowing. Not that it's exactly market, but LIBOR plus 300 would not be unheard of in your typical commercial banking context. And it's being offered and underwritten to businesses that could otherwise qualify for lending. And one of the things the Federal Reserve has emphasized is that this is subject to underwriting the same way other commercial credits are offered by that lender. So with that being said, you can think, this is not like PPP. This isn't a grant disguised as a loan. Instead, this is truly a near market loan designed to provide liquidity to borrowers in that middle market segment. Importantly, borrowers can't repay debt of equal or lower priority. There is some exceptions for mandatory principal payments. We'll talk about some of the concerns with that, particularly as loans mature. How early can you refi them using these funds? Because clearly you could pay them at maturity, but obviously most commercial borrowers don't wait until the day of maturity to begin negotiating a renewal, extension, or refinance of that particular credit. And so it's still not exactly clear how early you can go. A borrower can't seek to reduce or cancel other lines of credit with the lender. Less of a concern so far expressed by the borrowers, but is floating out there because the lender obviously has a similar certification. What is particularly interesting here is there is, similar to what we saw spike up in the PPP cases, there is a necessity or necessity-like certification where a borrower has to certify that they require the financing due to exigent circumstances, and that, importantly, they will make reasonable efforts to retain employees. A lot of criticism from the Hill about the reasonable efforts as opposed to mandating that this be used for payroll, but also just be aware there is a similar certification to the concerns we saw in the PPP program that a borrower is going to make, that they require this financing due to exigent circumstances. What has struck borrowers potentially most in looking at the terms of the Main Street Lending Program is you can't pay dividends on common stock or repurchases unless that was in place prior to March 27th, 2020 until the loan is paid off. And then even potentially more important for mid-sized businesses is there are compensation restrictions, and those last for the term of the loan plus 1 year after the date the loan is no longer outstanding. As it stands now, there is not a prohibition that says if you pay off the loan early, these restrictions fall away. It's one of the concerns that's been raised on the Hill. We're still waiting to see what will come of that, but potentially you could pay off your Main Street loan and then still be subject to the 1 year or 12-month tail restrictions associated with borrower certifications. Obviously, we'll get into a lot of that on Tuesday on our borrower-focused presentation. A few of the general criticisms, just to put this in context, we've talked about a number of those. Obviously, minimum loan size is $500,000, still becoming a major concern. The adjusted EBITDA calculation is a concern. You'll see it's either 4x or 6x of your adjusted EBITDA, taking into account also certain debt obligations you have. What that means effectively is a lot of early stage growth companies are being excluded. Anyone who's doing asset type who relies heavily on asset transactions is potentially excluded. And then there's some certain industry groups that have tended to be targeted because of those EBITDA calculations. And to date, the Federal Reserve has been unwilling to do any industry specific guidance, particularly even in those industries where commercial lending traditionally focused on other metrics for the viability of a business or their overall financial health. Most importantly, doesn't allow for refinancing of existing debts. We'll note one thing that was changed recently in the FAQs is there is some mechanism now for sub-S corporations to make distributions for tax purposes. However, there's still no specific prohibitions for real estate investment trusts or structured transactions or direct or indirect parent distributions that would allow you to make those types of distributions. So, some significant concerns still floating out there, even in light of the guidance that has been leveled already. Interestingly, only banks and certain international subsidiaries of international banks or bank holding companies can offer Main Street loans. And so if you think about a significant portion of the commercial lending market is through non-bank lenders. As it stands, non-bank lenders are not allowed to issue these Main Street loans under the different facilities. There's some ways for folks to partner with them, but as it stands, they are not one of the approved lenders. So interested to see if that is changed in future guidance. Few changes that came out in the FAQs that we'll just kind of run through very quickly. Obviously, a lot of these will be covered in greater detail during the borrower discussion on Tuesday. There was some clarification about who's eligible. You must be a U.S. business, and there's now some tests in existence for determining if you are based in the U.S. based on assets or employees. So there is some fairly clear guidance if you have international operations. We obviously talked about the borrower certification of unable to secure adequate credit from other banking institutions. So just be aware that that certification is out there. We saw it become a major issue in the Paycheck Protection Program until SBA surprised us all and somewhat eliminated it in a final set of FAQs. Clearly, it is not designed to be a grant. There are specific prohibitions on loan forgiveness, and so you cannot reduce the principal balance. There are some mechanisms to expand the term or potentially forgive interest in bankruptcy proceedings, but there is no intent to forgive any portion of the principal. Important for lenders, and I flagged this for a lot of folks, has finally been clarified. You cannot charge interest or additional fees beyond those provided in the terms of the Main Street Lending Program facilities, except you can charge de minimis customary fees such as appraisal or legal fees to actually handle the closing. But because the rates are set at LIBOR plus 300 basis points, you could not run that up to LIBOR plus 400 or something to that effect, or charge additional fees beyond those origination and transaction fees that can be passed on to the borrower that were identified in the terms. Each lender is going to be developing its own loan documents. There is some handy checklists that we'll talk about in further detail. There are mandatory terms that the Federal Reserve SPV is going to require to be inside of the loan documents. But it's not going to be like PPP where there tended to be a form that is then adapted by the bank. Here, the bank is going to use its own forms and then insert these mandatory language and disclosures. So it's going to be incumbent for you to work with your attorneys and advisors who help you document commercial loans to get those in place, given the timing obligations here. Obviously, we'll talk about Appendix C. There's a series of ongoing obligations. At one count, depending on which program you're in, there's anywhere from about 20 to 40 ongoing disclosures that borrowers are going to have to file, reporting up to the SPV and to the lender. And so we'll talk about that in detail. Interestingly, and we'll talk about some of the servicing obligations in further detail. There was some clarification, which is in the event a borrower defaults on one of these Main Street loans, the lender, the bank, must follow its standard work processes, meaning, you know, we're back into what we internally have been referring to as kind of the loss share conundrum that many experienced during the recession, which is, you know, the question of what is market standard work processes is something that's going to be handled on a somewhat of a case-by-case basis, it appears, and may be subject to who you're speaking to at the time across the table. Like PPP, still have BSA AML obligations. However, there is no requirement, just like we got clarified in the PPP, to obtain beneficial ownership on an existing customer if you did not have it already and it's an existing customer. One question that did come up, we flagged for a lot of lenders, is the EBITDA calculations. There's some question as to how you do an adjusted EBITDA and what mechanism and methods the lender was using, particularly if the borrower was not an established borrower and had used a calculation for adjusted EBITDA. Under the revised FAQs that were issued, you must just simply use a method for similarly situated borrowers that was in place before the date of the act. So with that being said, you would just go back and look at how you've done it for similar borrowers. Once you pick what that similarly situated borrowers model is, you can't customize it on a one-to-one basis, meaning you can't pick a method that is best for that individual borrower. Instead, you have to pick a way of doing adjusted EBITDA and then apply it across similarly situated borrowers. And then one of the things that we'll cover in a lot of detail is there's been some clarification as to the collateral coverage and how that works inside of that priority loan facility, but we'll save that till we get into that in detail. Just last 2 days ago, U.S. Senate held hearings. There were a number of questions raised about the Main Street Lending Program. We put those here just for things to think about, to be prepared for as a lender. But, you know, one of the things we've been hearing most, and it's reported by the American Banker, as well as the ABA and ICE, Independent Community Bankers Association, is there's been not as much interest in this program from borrowers. Still waiting to see what the uptake is on this, but generally a lot of bankers have said because of the restrictions in the Main Street Lending Program, there's not that fervor or that, I guess excitement's the wrong word for it, but excitement surrounding the Main Street Lending Program. And so interested to see what the uptake rate is going to be, but there are some pretty significant restrictions on this, and a lot of borrowers are just simply unwilling to abide by those. One thing to be aware of is the Fed has announced that it's going to publish the names and details of the participants in its facility, same thing the PPP has. And so as you're thinking about, who you're dealing with, who you're working with, just be aware, whether you're a lender or a borrower, that that information will become public. As such, you need to be prepared in case there are some concerns associated with that. And then, obviously, the senior economist here at the Economic Policy Institute had raised some of these, which is there's concerns about whether or not this is truly going to get folks back to work. There's no mandate like in PPP that makes these funds be used for payroll. Instead, there's just a simple obligation to use commercially reasonable efforts to maintain employment. Not a ton of guidance that's been issued on that, but it's not restrictive like the PPP where it must be used for these purposes. Obviously, the trade-off is this is not a grant program. It's designed to be either market or near market lending terms. With that, we'll kind of dive deep into the lender documents, and so I'll hand it over to my colleagues here.
Thanks, Brad. So we wanted to start first with the servicing agreement. So lenders must submit the executed servicing agreement at the time the loan participation is sold into the Main Street SPV. It's important to note that the servicing fee within the servicing agreement is defined as a quarter point. And it's paid by the SPV to the servicer annually in arrears within 60 days of each one-year anniversary. We also did want to call your attention to this last bullet point here, which discusses the financial reporting obligations that's placed upon the servicers. As a servicer, you'll have to abide by these requirements both quarterly and on an annual basis. The servicer is going to be required to collect information from the borrower, which includes certain financial information, calculations, and other financial metrics in respect to the borrower, including their assets and liabilities, and deliver such information to the SPV. The reporting method which the servicer is going to have to kick up this information has not been defined yet, but will be put out by the SPV shortly, we're assuming. The metrics that are required to be reported from the borrower to the servicer are found within the FAQs in Appendix C. The Appendix C is titled Required Financial Reporting. The borrower will be bound to report this data to the servicer by a financial reporting covenant found within the other documents that we're discussing here today. Within the FAQs in Appendix C, there are two tables. Table 1 covers the annual reporting requirements, and Table 2 covers the quarterly reporting requirements. They're quite robust. Each facility has slightly different requirements, which are identified within the two tables. As a servicer or as a lender servicer, you should understand the reporting requirements fully prior to deciding if you're going to participate as a lender servicer for the program, given the amount of capacity needed to properly comply. We're also highly recommending that you develop a compliance program around these reporting requirements to ensure adherence to the covenants, as well as other requirements that come along with receiving federally backed loans such as this. And we'll discuss the liability that you're warding off later in the presentation. Next slide, Brad. The co-lender agreements. This agreement, when applicable, turns a bilateral loan into a syndicated loan, with the eligible lender acting as the administrative agent. The co-lender agreements comes in two parts. One part covering transaction-specific terms, which has to be submitted to the SPV when the loan participation is sold into the SPV. And the second part is the standard terms and conditions, which is not required to be submitted to the SPV, but required to be executed and retained. The standard terms cover expected issues when looking towards syndicated loans, such as indemnification, reps and warranties, assignments, which are allowed, but assignments are not allowed to the borrower or any borrower affiliates and no natural persons. A form of the assignment is also included in Exhibit A of the co-lender agreement. There also is a section in the agreement that covers Patriot Act notices, which allows the lender to comply with the CIP and KYC requirements of their internal programs. It is important to note that the rep and warranty section is a little limited. We recommend that you review it and just take it into account when determining your participation. Next slide, Brad. I think we're going to go over to Brendan for these.
Great, thanks, Craig. So on the lender side, there's two parts I'll talk about. The first are the lender registration documents. Just look at these as the one-time documents that the lenders would enter into in order to be participants in the program. The lender registration certification and covenants section I'll talk about in a moment in some detail. It is signed by the CEO or CFO of the lender or an officer that performs a similar function. And then lender wire instructions that just permits the payments to transfer in the process. Next slide. So in the lender registration documents, the officer is certifying that they're an eligible lender, which I think as Brad indicated earlier, is just generally look at it as a financial institution or an affiliate of a financial institution. It's also, the officer is also certifying that the lender is not a covered entity. This goes back to other provisions in the CARE Act that is intended to limit participation in some of these CARES Act programs to organizations that were controlled by a government official. The government official is a public list, but essentially it's legislators, congressmen, and senators, as well as heads of executive branches, the president, et cetera. And that is a published list. It looks, what you're trying to determine in terms of whether or not your entity would be a covered entity is whether or not 20% or more of any class of equity of the lender is controlled by the government official or a family member. And while we don't expect this to be common, there is still a required level of diligence that is set up in the lender certifications for organizations to go through. You could sort of essentially look at it as a safe harbor. If you go through these processes, that in the future, if something came up, you would obviously go back and say that you followed all these procedures in order to ensure that you were not at the time the certifications were made. You must consider in your review any interest held by a covered individual, which is one of these government officials or a family member, which you have actual knowledge. So if you know of something, you're required to report them. For any 5% or greater holders of the organization, you do need to look through to beneficial owners and to make some determinations as to whether or not they would be government officials, and their calculations for calculating indirect interest holders through entities. Public companies can also rely on public SEC filings like Schedule 13s. And then lastly, there's a certification from the officers that the entity, the lender, is not insolvent. I think generally for financial institutions that should not be a big issue. So each of the facilities has its own specific lender certifications and covenants, and these covenants will apply to each loan that is participated in the program. I'll speak on the next slide as to just some generalizations. They are customized for each facility, generally tracking the unique terms of each of the facilities. So the officer of the lender would certify with respect to each of these participated loans a number of things. After due inquiry, the borrower certifications regarding its eligibility are correct. The important thing there is it's similar to, say, the PPP program. In general, the lender is required to rely upon the vast majority of the borrower certifications. However, you do have a due inquiry standard with respect to the entity itself. So as under the PPP program, the lenders would be looking at formation documentation to ensure that the borrower was in place at the required time period. I think it's March 13th, and that the borrower is in good standing, things of that nature. So you still have that obligation, but beyond that, the lender is permitted to rely upon the certifications of the borrower. The other certification is that the loan would conform with the requirements of the specific program. So again, these are detailed in each of the certifications depending upon the program, but it essentially tracks all of the unique characteristics of each program that you're certifying that those are included in the material. So for example, if there's a specific financial covenant requirement in a loan program, you are certifying that your loan documents have those features built into them. And the one thing to note there is it has been provided in the guidance from the Federal Reserve, is that the loan documents can be and probably should be the bank's standard loan documents, but you will have to customize them to conform to the requirements of the program. The next thing that the lender is certifying to is that it's conveying the full 95% interest and retaining a 5% interest, or in the case of the priority loan facility, an 85/15 interest. So this is confirming that you're doing a full participation in each case for the amount that's specified in the program. The next certification is that to the extent that the borrower has other loans with the lender, that as of 12/31/19, that these loans were rated pass or better. I'll note from our review at this point, not sure whether this would cover affiliates of the borrower. It's very specific that it's the borrower, but it's an open question, and ideally we'll see some more guidance on that coming out. And then lastly, that the lender will not request early repayment. So again, this would be the lender's not going to make a request. It doesn't mean that the borrower cannot do it, or cancellation of existing loans and lines. And that would apply to all of the loans. I think John, we'll go to the next slide, and I'll let John talk about some of the loan document checklist features in the participation agreements.
Yeah, thanks, Brendan. With regard to the loan documents, we'll generally focus on what was provided in Appendix A of the FAQ. And as both Brad and Brendan stated earlier, is that the lender should be using its own documents to close the Main Street lending program. And as provided on the slide, of specific note, the loan documents that should be used should be substantially similar to the lender's loan documents for similarly situated borrowers, which you then take and adjust to reflect the proper Main Street terms. So with regard to the lenders, I imagine that you may have your core set of lending documents that you use for these types of loans. Those are then provided to outside counsel to plug in the transaction-specific details. And as Brad mentioned earlier, with the time rapidly approaching of when these loans are going to be made, and we would certainly recommend that you go ahead and take out that core set of documentation, work through Appendix A and update it with proper payment terms, covenants, so on and so forth. Obviously, the documents for the most focus will be your promissory note and your loan agreement or your credit agreement. But again, would recommend that, as opposed to potentially having each the Main Street terms drafted in on a transaction by transaction basis, go ahead and pull out your core loan document set and begin working through Appendix A to make sure the applicable terms for Main Street are included. One specific note on this slide is that in the middle of the slide, it does note that if the lender wants to make the receipt of a commitment letter from the SPV a condition to closing the loan, that will need to be included as a provision in the loan documents. The guidance provides a sample provision, which is noted on the slide here. So I would presume that in most instances, the condition to close the loan would be that you're able to participate the loan to the SPV. So that's an important note to be sure that you consider for your loan documentation. Brad, you can go to the next slide. As I touched on a little bit earlier, Appendix A does a good job of going through each of the various types of contractual term provisions that need to be considered and amended for purposes of the Main Street loan documents. This slide gives the general categories of each of those terms. Maybe one thing to specifically point out, as Brad mentioned earlier, is your interest rate. With the interest rate initially being based on LIBOR, certainly want to pay close attention to the fallback language that will result in your new index after 2021, presuming that LIBOR, in fact, there's a sunset to LIBOR. Again, in Appendix A, the materials are very good about giving the specific terms. So as you work through your loan documents, Appendix A is a good tool. Go to the next slide, Brad. On to the loan participation agreement, which was provided as a part of the new materials that were released. It's similar to the co-lender agreement. This agreement is divided into two documents. The first is your transaction-specific terms agreement, which is generally the document that you will enter into with the SPV that provides your deal-specific terms, essentially a term sheet, if you will. And then that the transaction-specific terms agreement incorporates what I'll talk about in more detail in a minute, the standard terms and conditions. With regard to the standard terms and conditions, this is the document where the legal contractual terms of the participation are provided. There are certainly provisions in the participation agreement, standard terms and conditions, that are specific to the Main Street program, but it's good in that the participation agreement doesn't seem to be completely one-sided in favor of the SPV, which I think was initially of some concern for lenders. Overall, that the participation agreement seems to be a fairly customary type document for loan participations of this type. And Brad, you can go ahead to the next slide. So with regard to the participation agreement, I will say it's not the easiest document to work through. It starts with a pretty complex set of definitions, which are then integrated into the legal contractual provisions in the participation agreement. I wanted to briefly touch on a few of the important provisions in the participation agreement that, number one, could be very important with regard to how the lender administers the loan. And then number two, some of those provisions which are always important in a participation agreement in order to try to avoid disputes amongst the various lenders, in this case, maybe disputes amongst the lead lender and the SPV, such as voting rights and those sorts of things. So quickly on this slide, I'll just note a few of these important provisions. With regard to the nature of the participation, it is structured as a true sale, and it should be treated as such from an accounting standpoint. The sale of the participation is irrevocable, and the good thing is there is a provision in the agreement which notes that there are no putback or buyback or rescission or avoidance requirements, even if there is a breach of the agreement or a default by the borrower. Again, I think this is a good provision for the lead lenders that may have been worried about situations where the SPV would be able to put back the participation in the event of, let's say, an unintentional breach of the participation agreement. So again, the nature of the participation is in fact of a true sale. With regard to indemnification, there are mutual indemnification clauses in the participation agreement. Specifically, I wanted to note that there is indemnification also for the seller, which would be the lender here, the lead lender, on a proportionate basis for the actions the seller takes at the direction of the SPV, which we'll talk about a little bit later. So, this is good. This should give some comfort in the event. Let's say, for example, in the event of default that leads then to enforcement actions. Sometimes those certainly can lead to counterclaims, lender liability type claims, and the indemnification provisions would be good for the lender in terms of receiving indemnification for those type claims. Next is costs and expenses. Again, I think this is a very important clause and one that we had discussed prior to the release of the participation agreement and wondered what the participation agreement was going to provide. Presuming the loan may go into a troubled state, let's say the lead has to advance expenses to protect the collateral or engage legal counsel to enforce its rights under the credit documents. There is a provision that the SPV will promptly reimburse the seller for out-of-pocket costs. So again, it's good to know that as fees may have to be incurred or advanced, again, to enforce rights under the credit agreement, there's a contractual obligation that the SPV promptly reimburse those costs and expenses. With regard to distributions, generally speaking of in terms of the loan payments, those have to be submitted to the SPV promptly. If not, you can run into a situation where interest is accruing on those amounts. The participation agreement requires that cash payments be submitted within 2 business days of the lead's receipt of the payment. So again, you just want to make sure that you've got the proper operational systems, procedures in place such that those payments can immediately be remitted to the SPV. With regards to notices and records, this type of provision is not atypical for a participation agreement, but I did want to mention that there is a relatively broad affirmative requirement on the lender to provide all written documentation to the SPV as soon as practical. I would imagine that the broadness of the clause may create some confusion or ambiguity regarding what information that is necessary to be submitted to the the SPV, as a lot of times written communications with regard to these loans can be numerous. But we did want to point out that this obligation exists, and to also be sure that, again, the procedures are in place, and that your bankers understand that as information from the borrower or any obligor comes in, a lot of times that's going to have to be shared with the SPV. With regard to transfers of the participation, again, a very important provision, and so much so it was addressed by the Fed in the FAQs. And this is talking about the SPV's right to transfer or sub-participate its interest in the loan. Generally, consent of the lender is required for the SPV to be able to transfer its interest, except in certain circumstances, which we've listed on the slide here in the exceptions. And just briefly to mention those exceptions would be the SPV could transfer its interest to another governmental entity. A big one to note is that if there is a payment default by the borrower, the SPV could then transfer its interest without the consent of the lender. Bankruptcy proceedings or similar type insolvency proceedings of the borrower or the lender. If there is an act that may result in impermissible loan forgiveness under the CARES Act, a transfer could be required, and then also if a transfer is required by a statute or mandated by a court. Again, if you're looking to the FAQs, that would be in those provisions are in FAQ J4 and are important to specifically note. With regard to voting, again, another very important provision in the participation agreement that you want to have a good understanding of and be comfortable with. What this provision does is it sets up a concept where there's a defined term of core rights acts. And in order to take a core rights act, which I'll give some examples of in a minute, you're generally going to have to seek the instruction of the SPV, which will very likely be the majority holder of the obligation of the Main Street loan. Some of those core rights acts, again, it's a pretty broad definition, and it's those major actions that you take with regard to a loan. So increases or extensions to the commitment, reductions in principal, the rate of interest, reductions in fees or other amounts payable, delays in making payments, changes to pro rata sharing provisions, releases of collateral, an amendment to the credit agreement, amendments to the cross default provisions, and the list goes on. But again, it's those major actions that will require some instruction from the SPV. There is some cases where the claims may not be divisible, or in certain bankruptcy contexts where the voting rights go to a majority of the holders of certain claims. So again, you'll want to be familiar with these provisions. But again, just note it's important that as you make the loan and go into the loan, go ahead on the front end and consider the voting provision and understand what your obligation is going to have to be in order to get instruction from the SPV in order to take these core rights acts. There was also a FAQ, it's FAQ J6, with regard to how the SPV will approach its voting rights. This is similar to what Brad, I believe, and Brennan had mentioned, that they specifically call out again that the MSLP is not a grant program. And as such, the SPV is going to make commercially reasonable decisions to protect taxpayers from losses and not be influenced by non-economic factors. I think this is it potentially could be analogous to the loss share transactions where pressure was put on the bank certainly to maximize collections, and that there will be a consultative process in working with the SPV on some of the enforcement actions that may need to be taken. Continuing on, the standard of care, similar to many commercial participation agreements, the standard of care for the lender does not rise to the level of a fiduciary standard of care, but it's the same standard of care the lender would exercise if it held the rights for its own account. So I think the important thing here is that lenders certainly consider their written loan policies, and if there's any need to potentially deviate from those loan policies, which could be seen as a deviation from a typical standard of care, you would certainly potentially want to consider that and maybe have discussions about any deviations from loan policy where it doesn't appear that you are otherwise deviating from a typical standard of care. Also, elevation, an important provision. There are rights for the SPV to elevate its participation. It's similar to the transfer the transfer rights of the SPV, and there is a FAQ on this as well. Generally, the SPV cannot elevate without the prior consent of the lender, except for these certain circumstances which are mentioned in the exceptions bullet on the slide. Again, it's things like a payment default, bankruptcy proceedings of the borrower or the lender, impermissible loan forgiveness, and then if it's required by a statute or court. Speaking specifically to the FAQ, it was noted that the Federal Reserve in the FAQ says that it does not expect to elevate its rights as a matter of course. Specifically speaking, if the borrower becomes a troubled borrower, and again, the SPV does not expect to elevate, but instead would request that the lender follow market standard workout process. But they did note that in situations where interests may be misaligned or the loan amount is large in comparison to other loans in the SPV's portfolio, that the SPV may choose to elevate. Again, you'll want to closely review the participation agreement, discuss it with your counsel, and be familiar with your obligations going into each loan transaction. Brad, you can go to the next slide. I'll hit on this very briefly. Appendix B, it's similar to what we talked about with Appendix A. Appendix B to the FAQs mentions the covenants that are needed in the loan documentation. The different covenant categories are provided on the slide. And the good thing is Appendix B did provide some sample language to be utilized for the covenants. And again, that should be a good resource for lenders as they're reviewing and revising their core loan documentation. And I think I'll turn it back over to Brad.
One of the issues that has come up is this issue where originally the Fed had planned to use SOFR as an index, SOFR plus some sort of spread as an index to set the interest rates on these. Obviously, based on pressure, they're now back to LIBOR. You can use either a 1-month or 3-month LIBOR plus 300 basis points as your interest rates. But one of the things that we just wanted to flag is to be thinking about some of these issues with how you're going to document your replacement rates. And it's something many banks are already doing as part of their overall structure. Yeah, if you look at some of the spreads that have developed inside of the prime versus SOFR versus LIBOR, they're starting to get pretty dramatic, particularly in the last few weeks. And obviously in late 2019, you had the big SOFR spike that did not move with LIBOR. Obviously, there are pressures right now by the United Kingdom's Financial Conduct Authority to keep LIBOR in place. So it may continue on past 2021, but any of that work you've been doing regarding your replacement rates, you need to be thinking about as well, because it's going to be material when you're dealing with these Main Street lending programs, particularly some of these issues with the volatility inside of SOFR. We ran here just a quick comparison, using a volatility calculation to look at the relative volatility of SOFR versus LIBOR. So it's a big issue that you need to be aware of, particularly how the rates have started to diverge as we've gone through the pandemic, so that you know what that difference is going to be and you're effectively modeling for it as you're thinking about your retained percentage, but also because potentially the Fed is going to be looking at that in terms of reasonableness of those alternative indices. One thing we did want to point out in our last few minutes is some of the pitfalls that we see. perhaps the most important is understand with these timing requirements, your bank needs to be prepared to underwrite, obtain a massive amount of documentation, and retain it in an enforceable way. With the window closing on September 30th and the requirement that most of this be done on kind of a one-off manual basis specifically for this program, meaning there's limited ability to use some of your forms vendors or your existing underwriting and documentation software, make sure you've got the right people, they're prepped up, and you're working with the right team to make sure that they understand what the requirements of this program will be. If you're working with your outside commercial lending counsel, make sure he or she understands that there are a number of very specific requirements inside of the Main Street lending program that need to be addressed inside of those loan documents. And then practically speaking, a lot of our clients have been coming to us and saying, we're looking to do some master document sets, and then either using those on a unified basis or then pushing them out to outside attorneys with whom they're working. Understand that there are a lot of very detailed certifications, and a great point Brennan made to me as we were talking this morning is if you actually go through all those FAQs and examine them, there are some very specific certifications that you're making, even one that requires that you conduct diligence and then document that diligence to make sure that certain individuals are not governmental actors or governmental officials. And as long as you did the diligence and you maintained the documentation, you're given a safe harbor. But if you don't kind of check that box of going through and doing that particular process, you may not be subject to that safe harbor. So make sure you're understanding all of these very nuanced requirements inside of the Main Street lending program, various agreements and documents. Remember, just like with PPP, you as a lender are allowed to rely upon borrower certifications. However, there is some diligence that's set forth inside of the lender obligation documents, and you'll need to maintain that documentation on a go-forward basis. Similarly, just understand as you're going into this, there are numerous covenants that will be subject to enforcement because of the servicing obligations. There'll be some level of diligence that the lender is required to maintain looking at these. Other information that's available there that you may be collecting from the borrowers. Particularly if you think about those reporting obligations of borrowers, there's, in essence, dozens of reports that are going to be submitted that have to be submitted, then provided to the SPV so that everybody understands what it is that's being required. Let me go back one. Sorry about that, folks. Understand that, if you're having issues with underwriting these loans, the SPVs presumably are going to be comparing the performance of your loans against peers. And so that may lead to additional scrutiny. As I say, we're still unsure what the level of scrutiny that will be, leveled upon your underwriting. But understand that all of the documentation clearly indicates that the SPV has a right to look at the underwriting for compliance, both with the requirements and with your normal commercial underwriting guidelines. And then kind of the offshoot of that is we've seen already the litigation over PPP with very basic underwriting that was associated with it. There's going to be more underwriting obligations as well here, and so there's potential for fair lending issues, discrimination issues, as well as making sure you're keeping up with various decisions and denials for compliance with those regulatory regimes. So make sure you're aware of those and prepared for those. And then candidly, make sure you're prepared to do complex participations. You're going to have very expedited underwriting. What most banks report, according to American Banker article, takes 8 to 10 weeks. You're going to try to condense down into 1 to 2 weeks, which inherently is going to carry some additional risk associated with it. Understand there's going to be a lot of manual underwriting. Understand you're going to have these increased servicing obligations in the same way you have with other participations. If you're new to participations, make sure you're prepared for that, and that your accountants and the various financial units within your bank are ready to account for those participation interests, because the Fed has been giving some guidance on relief in terms of how you're going to show these on your books, making sure that you're not unduly encumbering your existing asset ratios and what have you. And then make sure you understand these new and somewhat complex types of credit underwriting, some of these requirements about getting subordination so that you're putting these Main Street lending programs in priority positions or in pari passu with other obligations. all requires fairly complex analysis of other existing debt obligations of the borrowers. And so make sure that the lenders you're going to assign to work through the Main Street Lending Program is going to have the capacity to do that fairly complex underwriting, because those are absolute obligations and within the lender certifications that are going to be met. Turn it over very briefly here at the end to Craig for a little discussion of the FDIC.
Thanks, Brad. I'll try to get through this quickly to leave some time for any questions that people may have. With any new program or new product, we recommend that our clients begin their rollout with looking at how their regulators will examine their activity and work backwards from there as a best practice to build applicable controls. The speed at which these programs, such as Main Street and PPP, are being rolled out and how they're evolving really are going to create a challenge for your risk and compliance departments as well as your business units. So here we pulled the FDIC examination procedures for covering loan participation and bulleted out what we know the EICs are going to be looking for within that space. So if you decide to participate in Main Street lending, you should go through these questions and make sure that you're contemplating these points when building out your program and your procedures that are going to, within this particular slide, the participations, but also in the program in general. Just like we're advising with PPP, you will not be able to cite the speed at which the program came into existence as an excuse for any non-compliance or your failure to think through a new activity, such as if you're new to participation, and failure to properly vet these issues with your compliance departments, your risk departments, and the downstream impact the program implementation has on your credit quality, your safety and soundness, a multitude of issues. Next slide, Brad. Oh, and not to end on a negative note, but we do want to point out the criminal and civil liability associated with participation within the program.
Way to go, Greg.
By no means do we want to make it sound like participation in Main Street or PPP for that matter is inviting criminal and civil liabilities or even outsized regulatory risk. But we do want to make sure that it's part of your conversations taking place among your senior leadership, among your boards, and within your various risk committees and other committees that are going to govern these programs. For example, as anticipated in the PPP program, we are starting to see activity from the DOJ where they're looking to leverage the False Claims Act, and we're starting to see an increase in class actions and covering PPP activity. We're fully expecting to see that come out from the Main Street program. And to avoid and limit your institution's liabilities here, we believe it's all going to be around your preparation, your preparing, and your documentation. How did you think about issues that were likely to evolve out of your participation within the program? How are you documenting the controls that you have in place and the decisions that you have made? So you can present that to a regulator. You can present that as a best practice if a class action is brought against you. You want to start thinking about that now and not put it off given the speed at which the program is approaching. And even if the program rolls out, you want to continue to think about it past the first day of origination. You want to start to gather the information that you may have been, that may be living in your email systems or maybe living verbally amongst the various business lines in your legal and risk department, and put pen to paper and just document what you're doing so you can present that, down the road in the coming months, coming years. That should be able to put you in a position where you can adequately defend yourself if challenged in any of these spaces. I think that sums it up. If we have any questions, Brad, back to you.
Thanks so much, Craig. Appreciate everybody joining us today. I will say next Tuesday at 11 o'clock, we'll have part 2 of this presentation, specifically focusing on the borrower side implications of the Main Street Lending Program. If you need any information on registering for that presentation, please feel free to reach out to any of your contacts inside Nelson Mullins or reply to the email that you received with the webinar invitation today. We'd be happy to make sure that is available to you. During that presentation next Tuesday, we're going to actually really start dissecting the certifications that borrowers are going to make and considerations that you as a Main Street Lending Program borrower may wish to consider. During this time, we'll have a few kind of final questions if anyone would like to send those in. We've tried to address a few as we went through today. One thing I would note is there has been some additional guidance issued on the affiliate rules. We had a few questions sent in regarding that, and we'll welcome the presenters to jump in if you have questions on that or want to comment on that. But in essence, both the certifications that are required as well as the applications reference looking across affiliates. And there are certain calculations, such as when doing the EBITDA calculation, you must include affiliates for that. I think there are some specific questions about whether you have to consolidate the debt calculations. No specific guidance issued on that, but everywhere else where they've dealt with affiliates, whether it's in the consolidation for EBITDA purposes, or alternatively in the calculation of U.S.-based businesses, they have said you have to look across all of the various affiliates, whether that's sister organizations, parents, or subsidiaries. Brennan, John, or Craig, any thoughts on that?
No, thanks, Brad. I agree with that completely. Yep, there's guidance in there regarding all of those matters. The definition of affiliates is still not clear in the certifications that are provided, but it is clear that you aggregate them.
Right. All right. Well, with that, thank you, everybody. As I say, we will have the slides available for you for your future reference, and the recording of this presentation will be provided on the Nelson Mullins website with links out to YouTube as well for all of the In the Trenches series. We look forward to speaking with you on Tuesday as we go to part 2 of the series, focusing on the borrower side of the new changes that have come out. I'd like to specifically thank Brennan, John Willis, and Craig Nazaro for joining us today, and look forward to seeing you next week as we continue these In the Trenches series. So hope everyone has a great Thursday. Thank you.
Thanks, Brad.